Hey everyone, hopefully you're having a good day. My name's Andy, my channel is Finding Value, and I want to get back to some of the questions on the channel. And I know I've been posting a lot of videos because there's just a lot going on. I feel like I got to get this information in your guys' hands so you guys can make decisions. But it says, what did an increase in rates, he's talking about interest rates, be headwinds for real estate prices? And I think what happens is people lose sight of what drives prices higher and lower and interest rates. So let me describe that scenario so you guys can get a good picture of inflation, deflation, and rates. So think of it this way. Inflation drives interest rates. So what drives inflation? It's the money supply increasing or expanding. That is inflationary. It's a credit expansion. And a credit expansion happens under an expansionary phase of real estate. Now, what happens before an expansion phase of real estate? That is what we'll call it the recovery phase in real estate. Things are recovering. And when they're recovering, what happens after the recession? We have this big recession, or maybe small, whatever the size is. We have a recession in real estate. Interest rates drop because we have deflation. And under a deflationary environment, or an environment where there's very low inflation, so think a recession in real estate and a recovery phase in real estate, interest rates are low. People are not borrowing. We have very low inflation rates during this recovery phase. And that's the perfect time that people go into bonds because they're not worried about inflation. So under that type of scenario, real estate prices are low, but they're recovering. They're gaining steam because what's happening in the recovery phase is you're recovering from a recession, an overbuilt inventory recession in real estate. It was overbuilt. Or foreclosures came on last recession. That was kind of a freak one from all those bad loans. And then we have to work off that inventory, and it takes some time, but it's not an inflationary environment, and rates are low. When we approach the expansionary phase, something changes, and what changes is the inventory of real estate. The demand exceeds the supply, and inventory shrinks. And in this period, home prices start to rocket higher. We were seeing this in the last cycle that we're in, the recovery phase from, we'll call it 2009, all the way till, I'd say about 2016, 17, 18, in that range, we started to see inventory dwindle down. Foreclosures were working those all the way off almost. All the foreclosures were about done in 2016. Then we started to see home prices start to increase more. Home prices started to increase. Inventories got really, really tight in the past couple of years, and prices started to rocket higher at a faster paces. What that does is it kicks on the home starts. And the home starts, once it passes the average, goes into an expansionary phase of real estate. That's what kicks this all off. And when we go into an expansionary phase of real estate, we're going to get the loans coming in, we're going to expand credit. And that's where inflation comes from. And that's where it has come from in the past. We did do a lot of money printing in terms of the Federal Reserve, where inflation entered the system, I'd say, a little bit earlier than what it would have if it was market driven. But I do think that this inflation that's come from the Federal Reserve is going to be carried over with real estate because real estate's ramping up. So we've got low inventory, home prices are shooting higher, we're building a lot more new homes. That is an expansionary phase. That inflation from the expansionary phase is going to impact interest rates. So what happens is you're going to get higher and higher inflation numbers and interest rates. It's going to put interest rates at a real negative rate. And what that means is that your inflation rate is going up, and the inflation rate is higher and increasing at higher paces than your interest rate. So the people who own bonds at lower interest rates than inflation are getting paid back with worthless money. Their money is declining in purchasing power faster than the interest rate is paying them. That's a real negative rate. And as the expansionary phase continues, it's going to put this real negative rate on bonds, where bonds, the bond holders, don't want to hold them. They're saying, I'm losing purchasing power at a faster rate than I'm getting it from interest rates, from the bond payout. So they sell their bonds. They say, sell, 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 sell. And that interest rate goes up the more sellers you get, because people are not willing to take that low of an interest rate with inflation going up. Now, when people truly realize this, the inflation rate will continue higher, and people are going to continue to sell bonds until they feel that they're going to get a real return. And that's going to take time, and usually what happens is the interest rates chase inflation. Now, back to the original question. Wouldn't an increase in rates be headwinds for real estate prices? Real estate prices have to become more unaffordable, not more affordable. More affordable means that you have a glut in housing. Less affordable is what happens when you have no supply and a lot of demand. So people are getting continually priced out of the market. And what the prices are going to do of existing real estate is price as many people as it can out to get an equilibrium. And then those people go and they seek to build new homes. They say, screw it, I'm going to go buy a new house. Let's go build one. And then more and more people are going to come to that realization and build more new homes. The interest rate is going to increase because of the supply-demand imbalance in real estate. And inflation is the driving factor of it. So the demographic is the ultimate driver. Real estate is the medium term, the intermediary between this. The inflation comes from real estate and the loans in the new housing market. And that's going to drive interest rates higher because of the impact of inflation on interest rates, putting bonds in a, quote, real negative rate. And if inflation continues to get worse with time, your interest rates are going to continue to move higher with it. So it is a headwind. Higher rates doesn't necessarily help the real estate market. But if you look at it from a different perspective, it doesn't necessarily kill it either. Yes, it becomes less affordable. I agree with that, 100%. But affordability isn't the driver of it, per se. It's a large supply-demand imbalance. And right now, we've had, I would say, one of the largest imbalances that we've ever had in that real estate market. The real estate market is short over 5 million homes. It's getting worse, not better. So more and more people are going to get priced out of real estate. And that has to happen in order to balance the market. Now, here's the thing that I think people tend to forget. As people are getting priced out of the market left and right, your existing real estate prices are continuing to go up. What's the limiting factor on existing real estate? What's limiting the price increase? Well, it's the cost of new homes. That's ultimately what it is. So if the cost of new homes is continuing to go up from inflation, which we're seeing the cost of new homes skyrocketing, we're going to see existing home prices continue to go rocketing higher, in my opinion. Another thing that you're also going to see is if this is a true market problem, a free market problem where we have shortages of homes, we are going to see rent prices skyrocket because people who can't buy homes are going to start to rent. And what are we seeing? We're seeing rent prices skyrocket higher. So we were seeing this alignment. All these things that are normally out here, they're all coming through and they're aligning like this right for us. We've got increased home prices, we've got increased rent prices, and we've got an inflationary push in new home prices. This is all signaling higher prices in the real estate market. When you do your analysis, look at inventory and days on the market and talk about inventory, active listing counts, homes available to purchase. Are they going up or down? And are they at a low level or a high level? A high level is anything above 6 months. A low level is anything below 6 months. That's kind of my cutoff point. If days on the market are continuing to decline, that means homes are hitting the market and they're going faster. You can't have home prices go down if your inventories are low and your days on the market are ultra fast. you have to build that inventory back up before prices are going to first slow down and then actually decline. A decline, I think we are very far away from a decline in real estate prices. That's my opinion. So hopefully I described that well enough. Interest rates are a headwind, but they're not the driver and they don't solve the problem of not enough homes. Supply demand will drive it. Inflation of new home prices will drive it higher. And this is all going to have to equal out, especially if you have as large of imbalances as we have. So people are going to be forced to make decisions. Do I rent at very high rent prices, or do I say, I'm just going to go buy a house? And I'm seeing people do that. They're saying, I don't want to rent anymore. It's too costly. I'm going to go buy and lock in my costs. So that is kind of the entire cycle there. And right now, what's going to have to happen is we're going to have to build enough homes, or the demographics going to have to go down in home buying years to balance this out without building more homes. I think we're going to have to build a lot more homes before that happens. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.